Welcome everyone to our Trade Policy Research Forum webinar today. My name's Ben Shepherd. I'm co-founder of the Trade Policy Research Forum with my partner in crime, Hannah Norberg, who's also here on the call today. Before we get started and while people are coming into the room, let me say a few words about what we're trying to do at the Trade Policy Research Forum. As you can tell from our logo, we're all about building bridges. So we try to bring together different aspects of the trade policy community and allow people to exchange in a supportive and friendly online environment. So one thing we like to do is to connect research with policy. This session is a great example of doing that. It's a really important set of practical policy questions that are being answered rigorously using research and data. So it's a really fantastic example of that sort of connection that we want to make. We want to bring together the different parts of the trade policy community, economists, lawyers, public policy professionals, practitioners, all these different groups who make the trade policy world work. Then another bridge that we'd like to build is between different areas globally. We can think of some of the centers of trade policy like Washington and Brussels and Geneva. But of course, there's a tremendous amount of energy and a tremendous amount of research going on in other parts of the world as well. So we're trying to connect people all over the world with what's going on centrally in the trade policy community. So today we've got a great session. Hannah will introduce it in just a second. But what I'd like to do is just to remind you that there are a couple of ways of keeping in touch with us when we're out of session. So we have a LinkedIn group with about 5,000 members. So that's a great place to post a paper and get some comments or ask a question, all that kind of thing. So please do go ahead and join our LinkedIn group if you haven't already. And we also have a mailing list, which you can find on our website, tpr-forum.org. And please do sign up for the mailing list. That's the best way of keeping in touch with our webinars. And we hope to see you frequently as we go through our series this year. I should say we've also got one special announcement, which is that we will be hosting a day together with our colleague and friend Maurizio Zanardi at the WTO Public Forum. So to bring research and practice into close collaboration at the Public Forum. That's a first. We're going to have a number of paper presentations and a number of posters that will be available there. So if you're attending the Public Forum, please do think about dropping past the Trade Policy Hub, as it's called, and we'll look forward to seeing you there. So that's all I wanted to say by way of introduction to the forum. As we go through the webinar, just a couple of instructions. We don't unmute people's microphones except for the presenters. So if you have a question or a comment, please put it in the text chat or the Q&A box here on Zoom. And either the presenters will answer it as they see it, if they feel comfortable doing that, or Hannah and I will pick it up for the Q&A session at the end of the talk. So with that, let me hand over to Hannah for a brief introduction of our topic and speakers.
Thank you so much for that, Ben. I would actually go as far as to think that even if you were not thinking of going to the public forum, you definitely should, because now there's an extra opportunity to hang out with us and to really learn some trade-related research there. I'm super excited about that. So that's mid-September, right? And so before I introduce the session and get us started, I would just, like Ben said, continue the conversation. Make sure that you jump into the chat box and write where you're coming in from, who you are and where you're coming in from, because that always kickstarts the conversation and it's so exciting. I see that some people already have. I also love to see so many new people in the group, and I also see some of our frequent travelers here, frequent flyers. I see Julia, Viaman, so great to have you all back. So this is a really interesting paper that Filippo is presenting today. So Filippo is an assistant professor at the University of Bologna. And then we have Anirudh Shingal from, let's see, this I'm not going to say very well, the SP Jain Institute. It is in Mumbai in India, so you can check it out for me watching it. And it's about, yeah, so I'm not going to even say what it's about, but we're going to have Filippo's going to do a presentation of about 20 minutes, and then we're going to have Irene do make some comments, and then we're going to open the floor. But one thing always happens, right, Ben? We always run out of time. Always. These sessions are always too short. So do not sit around and think that you're going to post your question later, because there might not be time. So as soon as the question comment comes up, go ahead and post it in the chat box. And yes, this will be recorded. And so we will get the presentations and the recordings up on the website after. So all you need to do is kick back, relax, and listen, and take part in the conversations. Don't be too worried about catching up, because you will be able to do a recap. So without further ado, I'm going to hand it over to Filippo.
Thanks a lot, Hannah. Thanks a lot, Ben, for the opportunity. So now let me share the screen here. Okay, no, not this one, this one. And so, again, as I was saying, thanks, Ben, thanks, Hannah, for the introduction. Thanks to everyone else from home for attending. Thanks, Anirudh, for the excellent comments that you sure will give us. So, I would be probably the cause of us running late. So if you see that I'm really way too, let's say, lagging behind, feel free to give me red light, and I try to rush a little more. So what's this paper is the, let's say, final, say of a long-lasting project. It started with my co-authors and at this point friends, Ben Hoekman, Marco Sanfilippo, and Hoitiku, from the European University Institute and the University of Torino, and it tries to well, it doesn't try, but it looks at the role of government demand as a tool to promote firm growth in least developed countries. Well, why is it relevant? Trying to look at the role of government. First of all, because the government tend to be a fairly large actor both in developed and as well in developing and transition economies. They tend to cover for a huge share of the total demand to the private sector. And the point is that the government does so on one side because it needs services, it needs supplies, it needs works to be done, and providing for them from, using internal people and resources would take a lot of time, would create an even larger government, which is hardly manageable. Rather, it can be used, so in addition to this motivation, also as a tool to somehow orient the economy, therefore to achieve objectives which are both economic and non-economic as a kind of industrial policy tool. In doing so, therefore, this non-economic objective can be that the market is too small. So government demand can actually increase, I would say artificially, but it's not, it wouldn't be fair, the size of the domestic market, and therefore helping firms to scale up production with all the gains that are usually associated with this kind of process. Now, I told that our paper is about least developed countries and, well, low-income countries, I would say. And our context is Uganda, where the government made clear that private sector development is one of the pillars of its domestic policy, and identified public procurement as one of the tools that this government wanted to use in order to pursue such a goal. In particular, there is this policy which we are not looking at because it kicked in after our. It started kicking in the years following our time, our observation period. So we couldn't say anything specific about this move policy, which is by Uganda, therefore trying to promote also domestic network of suppliers for firms entering procurement by creating essentially what we could refer to as rules of origin clauses within procurement contracts. So what do we do? I already said our objective is to understand to what extent government can use its spending as a tool to orient the development of the market and promote firm growth in those countries. What we do with that is to leverage on transactions level data, which collect the universe of all the formal firms operating in Uganda over the period spanning between 2012 and 2019, and try to understand with using this data to what extent selling to the government is associated with larger market share, larger, let's say, indicators of firm performance and growth. This data set, so I already said, includes the universe of formal firms. So I anticipate, let's say, one likely comment. Unfortunately, we couldn't track informal firms, and the informal market tend to be fairly large in Uganda. So unfortunately, we couldn't really observe this, and this prevented also us from investigating other very interesting questions. For instance, the transition to the formal, let's say, sector and the transition back to the informal sector, whether this might have been driven by serving the government. Okay, so because one of the requirements set by the government for accessing public contracts was, of course, to be informal firms, therefore paying taxes. So the incentive to formalize one in order to get one of those contracts is large, because there was no requirement of, let's say, long-lasting participation into the tax revenue effort, let's say, in the tax collection effort. And therefore, there would have been an incentive to move from the informal sector to the formal ones. Well, we couldn't answer this kind of question. So before, I mean, of course, it's kind of the elephant in the room, if we want to say so, but so I just put my hands ahead and say we couldn't look at this. So we exploit this data, which includes data on firm-to-firm transaction. Therefore, we can identify the selling firms, so we can identify its buyer, and whenever sales are included, we could also identify whether sales were directed towards either final consumers, which are not other firms, or and since we cannot track them, but anyway, it would have been a nice extension. Also, firms that are potentially informal, therefore have no identifying number, okay, tax identifying number. But anyway, we use this data to map also firms with respect to the way they enter a relation with the government, whether they, for instance, have nothing to do in terms of supplying to the government, or whether firms are regular suppliers, meaning that we always observe them somehow invoicing to the government, meaning that they have a long-lasting relationship, which is, I'd say, for the sake of our time span, permanent. We can identify firms who start selling to the government, therefore we can exploit this change in status between non-selling to the government to selling to the government to actually identify the effect of accessing government procurement on all these dimensions that I will describe later. But this is one of the things that I find really interesting. We can also try to plot the effect of losing access to government demand, which we identify by looking at the moment a firm stops invoicing to the government. Okay, since what we find essentially is partly consistent with the existing literature, mostly based on on developed economies, such as the paper by Di Giovanni and co-authors who look at the case of Spain. But what we find doesn't completely match the pattern that they identify for these cases. We couldn't even leverage the mechanisms that they suggest are in place. So what we do to actually find, to actually motivate, find a motivation for our result is to also complement our analysis with a survey which we ran a couple of years later, after, let's say, the ending period of our analysis, on procuring firms to try to get a sense of what's going on. In a nutshell, what we find is that, well, they say the good part is that selling to the government is indeed associated to an increase in total sales and sales per employees. It creates, however, a kind of crowding out effect, meaning that this increase in total sales comes at the expense of a reduction in sales to the private sector. And this crowding out effect, and here is where the case of Uganda becomes different from what we knew from the literature, is that this kind of crowding out tend to be pervasive and permanent and not reverse back once. For instance, firms adjust and solve potential capacity constraint that prevented them to retain the private market. And this result is also specific for the case of Uganda to serving the government, meaning that we ran several placebos trying to understand whether it's just the size that matters or there are other characteristics of government supplies that make that cause this drop and this loss in market share. And what we actually find is that, yes, it's a specific, at least for the case of Uganda, to the government supplies, because whenever we identify the same kind of shock, but looking at instead of to multinational firms or large domestic buyers which are not entangled with the government, we don't find this complete diversion. We find that firms tend to increase total sales, but without losing private sales to the private sector, other than these large firms that we identify as being in the shock. Okay. Interestingly, and this is relates to what I was saying before, we find that stopping selling to the government flips the results essentially. So we have a decrease in total sales compared to the moment when the firm was selling to the government. This loss is paired with an increase again in market share in the private market of private buyers, but the total loss in total sales don't make up for the increase in the private market. Okay, so this is also interesting, meaning that indeed government, at least for the case of Uganda, without making any claim of external validity yet, has severe implication for the growth pattern of firms. But this also raises question, because this means that this policy of handing money through public procurement doesn't have any permanent effect on firm growth in Uganda. And that was the final takeaway. I will go later on the possible explanation that we observed, and we find eventually, just to close this introduction, that government entities offering higher prices drive up total sales without actually increasing the capacity of firms. So our survey suggests that this is indeed the reason why we observe what we have, and this is slightly different from what other people or other scholars found in different contexts. So our contribution to the literature, therefore, is twofold. Methodologically, we track when firms sell to the government instead of identifying a single event that says essentially that a firm enters the club of government procurer. Actually, we map firms along their, let's say, path from their first invoicing to the last one, or from the last one to a period when they don't win any other contracts. And we exploit this possibility to actually find a different, let's say, kind of identification compared to the classical, let's say, before-after comparison that is common to the literature. Analytically, our contribution is that we document this crowding out effect, which is consistent both in when we look at when a firm starts selling to the government and when a firm stops doing so. And we rule out, at least for the case at stake here, that credit constraint, which was one of the likely culprits that we had in mind before actually doing our survey, is not really a factor, at least doesn't appear to be a factor among the firms we surveyed. So going very fast in data and empirical strategy, we combine firm-to-firm transaction, which we got from the Uganda Revenue Authority, and which include DAT declarations, meaning all the forms that an individual firm is forced to deposit at the Revenue Authority in order to pay taxes, essentially, which we complement with corporate income taxes, corporate income statement, employment details, and also imports and exports at firm level. We can match all these different data sets. Eventually, what we get is this final data set, which allow us to identify several firm characteristics, which we can use to eventually on one side match firms on during within our diff in diff approach, but also to break down the results, for instance, to see if there is any heterogeneity in the patterns that we observe. But most importantly, these data allow us to identify, and here I take some time, to identify different patterns of government suppliers. For instance, regular suppliers. So among the firms which are regularly reporting their VAT transactions to the Revenue Authority, we have, for instance, that 43% of firms report transaction in all periods, which is a big number. Okay, so 42% of the firms which are formal also report to have some kind of relationship with at least one government entity in every year we observe them in the country, in our time span. We have stayers, for instance, so firms that were not selling to the government when we first observed them, but at some point they emit the first invoice to the government, and we use this event to actually then distinguish between firms who do this randomly. Let's say they just had 1 year, they had a contract, they deposit this invoice, and then they stop again selling to the government or supplying whatever they are doing. From firms which instead, once they access government demand, they keep serving the government. Okay, and these stayers, in short, are actually the core of our analysis. And then eventually, for the, let's say, from the other side of the coin, we also focus on exited. That is, firms who exhibit the same pattern as the stayers, but on reverse. Let me go back. So without going to descriptive statistics, what we do is to actually first eyeball the data. What's going on? Well, can we just fitting a very simple two-way fixed effect, identify an effect of selling to the government without being so, let's say, sophisticated in defining the pattern, okay, of selling to the government? And what we find is indeed that, and here it is, selling to the government is associated with a set of results which are more or less coherent with what we were expecting from the literature. For instance, total sales increase. Okay, it's a big buyer, so of course total sales might increase because probably they are asking for an excess for a much larger demand than a firm was used to serve before getting the contract. The number of private buyers also increased. This is also consistent with the kind of reputation effect. Since a firm starts selling to the government, it promotes itself to some extent, also in the private market. With basic measures of productivity, for instance, sales per worker and value added per worker also increase. And this is respectively from whether we consider a dichotomic variable, saying a firm sell or doesn't sell to the government, or the amount of sales to the government. So both in a dyadic and continuous definition. However, what we find that was somehow puzzling is that the total sales to the government excluding the government, tends to decrease as much as the average sales to the private sector. And these two things suggest that there was some form of crowding out. The point was, when we saw these first results, okay, but is this transitory, like other people seems to suggest in other countries to be the case, or is this permanent? Because the effect was large. I mean, as you can see from the coefficients. Now, okay, here is a typo in the slides, but anyway, the point is that we had two potential sources of bias in these kind of basic results. On one side, we were just looking at all firms selling to the government without really distinguishing between, for instance, firms who are always selling to the government, and therefore, in this, let's say, in this setting, we couldn't really say anything about what's the effect of entering government procurement, because this effect might have been driven up by firms which are substantially different from the others. Okay, firms who always sell to the government might be different from firms who, let's say, access later on over period or never sell to the government. So the comparison made little sense. And the other thing was that the staggering nature of our data, so firms start selling to the government different moments in time, as much as they exit from selling to the government different moments in time, might introduce bias coming from, well, if for everybody who's used to the literature on differences in differences, there are several sources of bias. We therefore decided to go this way. So for the first problem, we decided to compare firms who access the government supplies over the period we can observe them, and we compare them with firms who have not yet entered government, have yet to start to be government suppliers. Therefore, a kind of treated versus not yet treated kind of setting. For the other, for the kind of the other bias coming from the staggered treatment, we decided to use this Callaway and Santana doubly robust diffing diff estimator, which allows for matching on a set of covariates, which, at least in principle, improve the identification of the effect by giving more weights, essentially, to firms which are similar under all other respect, which we are not looking at, for instance, all the characteristics that we include in our analysis, and giving less weight to firms who are substantially different, irrespective of their status, for instance, being treated in the same cohorts versus not being treated in the same cohorts. Our results, well, we find what I already introduced earlier on, so I will go very fast in terms of the data. We find this kind of remarkable increase in total sales following the time zero, the event, so the moment a firm invoiced the first, send the first invoice addressing at least one government entity over in 1 year, and we find that this effect is paired with a sharp decrease in the market share, in the amount. Well, I'd say market share, but what we are really mapping there is in the second graph, the right-hand one, is the total amount of sales to other firms who are not related to the government. Okay, companies. Mostly, we focus mostly on companies. Okay, so companies which have no public participation. Well, I don't think I have a slide showing that, but if we are to include in the analysis also sales to entities which are not recorded, and therefore we cannot say whether they are final customers or informal firms, nonetheless, firms are have to report on this transaction as well, but simply not expliciting how many customers were related to that amount they are declaring. The result stands. So this is really driven by the fact that accessing government crowds out sales to any other who's not the government, essentially. As an additional outcome, we show that conversely from what I showed in the scripted evidence, we have an increase in sales per employee, but no effect on value added per employee. So productivity, well, we can say something on the coarser measure of productivity you can think of, but once we start looking into more precise measure, I mean, something that would be preferable, let's say, such as value added per employee, the result is no longer there. And this potentially hides the fact that this is indeed something which is driven by prices. That, let's say, I would say that this spooked us a little and even pushed us to do the survey that we later discuss. We find evidence of an increase in domestic supply chain, saying that from the side of the buyers, meaning that the number of buyers, I would say, paradoxically increased, but the average sales decreased, suggesting that firms who sell to the government still have some capacity spared, and they prefer to sell to many customers who potentially need smaller shipments, as opposed to retain other large private customers. On the supplier side, we don't find a clear effect. So that's also interesting because really it means that there is no evidence that firms scale up production, because that's what we would have expected if they were to increase their production. That also the supply chain from the supplier side would have changed, and we find no evidence of that. Exiting government demand showed the opposite effect. Now focusing on the first two graphs, the first two plots, the top ones, we see that total sales decrease and that total sales to entities which are not related to the government instead increase. But the two don't compensate each other. That was interesting. So the total gain coming from sales to the government more than offset the loss in terms of sales to the private sector, and losing access to the government is not offset by the gain back by obtaining back private customers. I mentioned the placebo, for instance. We see, okay, is there can we identify the same effect for when a firm starts selling, let's say, to another entity which is comparable in terms of size. And to do so, we focus on big multinationals or big domestic buyers. The multinational, we borrow the idea from this paper by Manelici and co-authors on Costa Rica, where they show the effect of becoming supplier of multinational in terms of increasing productivity and firm size. But what they find is that this effect is permanent and indeed allow, let's say, an upgrade in the structure of the firm. What we find here is that, well, yes, total sales increase, but these total sales increase without losing other customers, at least sales to other customers which are not identified with this big buyer, okay? And the same happens for foreign firms. So the effect we find, it's interesting because it's really specific to government demand. What can explain this reallocation of sales, which is pervasive, and it doesn't seem to revert back as we would have expected if this was indeed a capacity constraint kind of story? Well, since we cannot borrow from the literature because they find different things, so their mechanism might not apply here. We decided to resort to a survey. So we went back to Uganda because, yes, we went there in the first place to get the data. And we went back to Uganda and actually had interviews with CEOs, okay, let's say, head persons for firms who registered at least one transaction to the government in the past 5 years. So we went there in 2023. So the period we were interested in was 2017, 2022. So not completely overlapping with the final years of our analysis, but still, I mean, we had to draw a line at some point because the recall bias might have been strong in this case.
Sorry, Filippo.
Yeah,
we're running a little low on time.
So I will try to rush. So, I mean, what I wanted to suggest here, I told you earlier on that I would have been late for sure, but let me go fast. So what we find essentially is that the point seems to be that the government is a large buyer, and that we know, but pays higher prices and sets longer contracts, so that there is no incentive to stay in the private market, given on the one side that firms don't know how long they will be able to serve the market, the government. Therefore, they don't find any incentive in expanding capacity. Also because, but this is anecdotal, that to expand capacity, they also need managers. And sometimes firms, especially family-owned firms, don't trust people outside of the family to take up this managerial position. And these also, to some extent, discourage at least this kind of firms from increasing in size, okay? Conversely, from Di Giovanni, we find that access to credit is not a key concern. We ran other additional analysis. Let me skip past, but in addition to the survey, we also tried to find if we could identify what the survey suggests in the data. And indeed, we find here is the capacity constraint. But yeah, we couldn't find anything about the price because we didn't have information on the unit price. That was a shame, but we could say that, yeah, it's not the delayed payment a problem that creates uncertainty, because the delay is way below the Italian standard for delays in payment from the public administration. So just to say one, I mean, that's it. In conclusion, we find this positive effect of central government, which tend to, however, to be transitory. But so far, I didn't talk trade. So I want to take 2 minutes to actually bring what I just said to the domain which is more familiar with the audience, I think. So what about trade? We didn't look actually at trade besides looking at the imports or export of these firms. But what's interesting is that we have some evidence that the requirements set by the Ugandan government, which were to actually source at least partially domestically and not result just on input from abroad, had indeed an impact. But this impact was not, I'd say, what's not really what we expected, or probably what the government was expecting. Because what we found, actually, and here I highlighted in the last, the effect where unexpected, is that, well, okay, direct foreign value added is modest. I mean, of course, some firms, if they have to provide to sell to the government and to meet an increase in demand from the government, have to increase inputs. If these inputs are not possible to be sourced domestically, they of course have to resort to imports. But this effect is not remarkable and tend to be, well, around zero to the large part, exclude some sectors like manufacturing that probably needs intermediates which are not produced in Uganda. But what was most interesting is that the indirect value added by sector increased a lot, suggesting that this requirement of sourcing domestically just shifted one ring of the supply chain upriver, let's say upstream, meaning that they supply from they get suppliers that import more inputs from abroad, suggesting that the net effect of giving money to more, let's say, sector of the economy is still mitigated by the fact that at some point these firms still resort to imports, but indirectly. And well, this is for export and import. For export, the same things applies. So I'd say that, I mean, this is just some descriptive evidence of what happened, that indeed we don't find much of an effect for the direct foreign value added, meaning that it doesn't decrease significantly, which is what probably the government was wishing, but we indeed find evidence of an increase in foreign value added, indirectly imported, so through their supplier. And this is again what I think the government was not expecting. So this is the kind of thing that we can expect when this industrial policy is used as this kind of omni tool, because it's not. It can address some things, but it cannot be seen as the single remedy to all illness, especially in contexts where the domestic market is not as sophisticated as, let's say, the US. I mean, US can do whatever they want. They are the US. Other countries, and I put also some European countries in the list, well, not so much. So that's the kind of takeaway story that I want to close on.
Okay, thanks so much, Filippo. That's I've seen this paper presented before. I really love it. So thank you for coming on and presenting it. I think it's a great example of really nice empirical work on an important policy question. You know, like you said, the government is the biggest source of demand in most markets, biggest single source. Sometimes you get a multinational that's kind of comparable, but often it's the government doing the heavy lifting. So knowing what that does when we focus it on particular firms, particular markets is really important. And I do appreciate you know, opening up the trade dimension at the end of the talk. Let me maybe hand over to Anirudh for his comments, because he's worked on procurement as well, but if I remember correctly, more from a trade angle. So he may have something that he can bring into the discussion there. So Anirudh, floor is yours.
Thank you so much, Ben. Everybody, you can see my slides. Excellent, great. So let me just begin by thanking Ben and Hannah for this opportunity, for getting me over, and Filippo for this, you know, this opportunity to go through a very interesting paper. So, you know, just at the outset, let me say I really enjoyed reading the paper. There's not too much work done on government procurement. So even from that perspective, I think it's a very useful contribution to the existing literature. So, you know, let me quickly discuss what I found extremely novel as far as this paper is concerned. So first of all, honestly, it's the research question, assessing the impact of government procurement on firm performance in an LDC setting is fairly novel. There's not too much work on this subject. There's work on, you know, in the context of Germany, the US, but not too much work in an LDC setting. So this is very welcome. I also find the analysis very neat. Clearly, the data has a lot to do with that. It's a unique data set based on match firm level value-added taxes, financial and employee data, and that kind of improves attribution. It makes it easier to identify some of the channels. Estimation, again, you know, this is again one very important part of the paper. In event study design, lens causal inference, staggered treatment accounts for treatment heterogeneity, obvious concerns emanating from forbidden comparisons, pretrends, etc. Everything that Filippo mentioned. And then I think a very striking part about the paper is its results. They are quite novel. So clearly the crowding out effect, the fact that selling to the government comes at the expense of selling to the private sector. And I think in an earlier version, the authors also showed that there were reduced effects for services, especially low-skilled services. And clearly what Filippo has also mentioned, this crowding out is not temporary, but it's actually persistent. It carries out over time. I think that's a very important result. At the same time, the results suggest that government demand improves gross profit and total sales per employee, and that firms that stop selling to the government do not actually switch back to the private sector. I think that again is a very novel finding, something which would seem to be counterintuitive unless one probed a bit more on the likely mechanisms and the peculiarities or the situations that might be specific to the country in question. So a few suggestions before I look a bit more at the trade angle, which is something that I'm more familiar with. But in the version of the paper which was uploaded on SSRN, I found a very nice table, table 1, which actually talks about the heterogeneity of government demand across sectors. And I think it would be quite useful to examine. So, in that version of the paper, what the authors have done is they've looked at the effects for agriculture, manufacturing, services, etc., etc. But what might be equally interesting is to exploit that heterogeneity for large versus small public demand sectors, and for sectors that are more homogeneous versus sectors that are more differentiated. And that also opens up an interesting link to trade and government procurement, which I'm going to talk about in a bit. But that is one of the reasons why I suggest that it might be interesting to do that. In terms of mechanisms, I know this paper has tried to go deeper than earlier versions, but again, I had some initial thoughts and just wanted to run them through. So could we link the positive impact on total sales per employee to productivity, to worker productivity? If yes, then it could be argued that government contracts are actually better paying, which results in the reallocation away from private demand. So that is one suggestion. Again, do we know that, or is it possible that government contracts actually exhibit more certainty or regularity in payments compared to, selling to the private sector? And if that is the case, so, normally we know from the literature that governments are notorious in making payments to, to the contracts that they've awarded to either domestic suppliers or foreign suppliers. But maybe in the context of Uganda, it might just be the case that the private sector is actually even more pathetic than the government, right? So in that case, the government has that advantage in terms of making its payments either with more certainty or more regularly. And that could explain why, for instance, why firms do not switch to the private sector even when government demand stops. Again, is it possible that the goods produced are so tailored to meet government demand that they cannot then go to the private sector, or sort of reorienting production would be too costly or prohibitive? Is corruption a possible mechanism, right? So in a scenario where the government is the larger demander, and that is what the data seems to suggest, in that kind of scenario, and if there are benefits to keep on getting tied in with the government, so is it possible that because of this sort of tied in demand, you still have an expectation that if the government is not demanding now, it might demand in the future, and therefore it does not make sense to move to the private sector, right? So there could be those kinds of mechanisms as well. And then I think, completely aside, I really like the data that the authors explored in this paper. And I was wondering if the analysis could be extended to examine the firm level determinants of being a government supplier, right? So right now, the paper asks a different question. If you're a government supplier, what is the impact on firm performance? But we could actually, sort of swap that around and say, given all the attributes that we have, the richness and the granularity of the data, can we explain why certain firms become government suppliers and others do not? And that, again, I think would be a nice contribution to literature, probably a new paper. Okay, so links to trade. And again, this is something I picked up from the earlier version, which said that domestic firms get over 95% of all government contracts, but this accounts for only 50% of total procurement value, which suggests that foreign firms actually get less than 5% of all government contracts, but this allocation is very large in terms of value, and roughly about 30% of total government budget. So clearly, just in terms of number of firms, the bulk of the contracts go to domestic firms, but in terms of sheer value, the foreign firms are pocketing a lot of the large value contracts. So that is where the trade angle comes in. Again, I was wondering if from the database, it's possible to identify if amongst the list of domestic firms, there are also some foreign affiliates or firms that might have tie-ups with domestic firms. in which case there could be a domestic versus foreign procurement angle. So not a direct foreign procurement, but an indirect foreign procurement, where the government is selling to a firm which has a tie-up with a foreign company. So that might be, again, an interesting angle to explore. But again, depends on whether whether the underlying data identifies that. And finally, there are some very interesting theoretical predictions on the impact of a home bias in government procurement. So basically, this literature suggests that every time there are discriminatory procurement practices, or you prefer a contract to be awarded to a domestic firm, there are certain implications for the economy, right? And there is a whole literature out there. And one part of this literature actually talks about something called the neutrality proposition, which says that under certain conditions, a home bias actually does not result in a fall in total demand for imports, because the fall in public imports is compensated by a rise in private imports. Okay, so which therefore renders the home bias ineffective as a policy instrument. So I was just wondering, what we see in this particular paper is crowding out of supply to the private sector by public demand, right? So is there some way we can link this? And the way I was talking about it is, and that's why I suggested that the analysis be done for homogeneous versus non-homogeneous sectors, or for small demand versus large government demand sectors, is because, Baldwin Richardson show, for instance, that this ineffectiveness of home bias exists when government demand is low and when the procured good is homogeneous, but not when the government demand is large. Brulhart and Trionfetti actually show that the home bias turns out to be effective in monopolistic competitive markets. Then in some other work, Miyagiwa shows that when the procured good is differentiated, then the home bias can actually increase total imports. So the rise in private imports more than offsets the decline in public imports because of a home bias, which is exactly the kind of result that we are seeing in this paper, but in the opposite direction, that a rise in that because of selling a contract or selling goods and services to the government, you actually end up selling less to the private sector, right? So it's the mechanism working in the opposite direction. So I was just wondering if there are some ways we can extend these theoretical predictions in the context of trade and government procurement to the kind of results you see in the context of Uganda. Just a thought, but maybe something that the authors can think about. Thank you very much.
Thanks, Anirudh. Really helpful comments. So you've taken us through the nutshell of the paper, and you've given us, I think, some really nice ideas to go on with. Maybe I just hand back to Filippo to see if he wants to respond to anything in the comments before we spend a few minutes on Q&A.
Yeah, I actually, first of all, thank you, Anirudh. Very great comments. Some of those we already had to deal with to some extent, and also thanks to all the people. Here I have took notes of Moses, of Salman and Sonali. Because their comments somehow relate also to what Anirudh was suggesting. So let me go through to the first two comments, let's say from Moses and Salman, and then I go to Anirudh. Which the first one is the one about the political connection of firms or corruption. Irrespective, two sides of the same of the same thing, essentially. And unfortunately, we couldn't say anything about it. This is, there is a huge literature in terms of politically connected firms. Unfortunately, we didn't have any information about the CEO's affiliation, whether the head of the firm was, for instance, a supporter of the Museveni government or not. So understanding whether the firm is politically connected and the extent to which this political connection can correlate with more contracts awarded, unfortunately, we couldn't answer this. Again, anecdotal evidence, because this comes from several exchanges we had with people at the Ugandan procurement authorities, public procurement authorities, seems to, well, not rule out the case, but at least downsize it, in the sense that the objective function of the government is not necessarily the one of handing money only to their own, but also to hand money to the real sector. to the economic sector in general, to entrepreneurs. Also because this helps keeping all, let's say, everybody in line, because if you want to have your share, you have to stay in line. So that's really the thing, that this political connection don't seems to be that much strong. It would be cool if we could single out firms who are politically connected to see whether this effect is indeed driven by these, but we unfortunately we cannot, because we don't have this information. So I think I answered to 2 points, and it was also mentioned by Anirudh in his comments. Then the point is whether the government contracts tend to be more stable compared to private ones, and this is also one of the points raised by Anirudh and but also by Salman. And well, yes, the survey suggests that one of the points is that government tend to commit to longer lasting contracts. The point is the government has long commitments, and these allow to plan, but this length, and this is what it suggests, I mean, other answers to our survey seems to point to, is that this increased, let's say, length of the contract doesn't imply that a firm is sure that these contracts will go on forever. And from these comes the, let's say, decision potentially not to expand capacity, because firms tend to be rational, and since they cannot, let's say, they cannot anticipate for how much they will be serving the government, and they cannot anticipate how low private prices will go if they decide to make an investment and increase their cost in the short term. So that could explain why we find this result. So of course, government, longer contracts, higher prices. One entrepreneur suggested that for some contracts, the government pays up to 4 times the private market price. And of course, total sales increase even if they don't expand capacity, because they earn 4 times as much for the same object. That's also let's say, the price of delaying payment. They get paid 5 months afterwards. But still, it's a huge markup, additional markup to what they produce. Then from Anirudh, I take the point of the heterogeneity analysis. I really take the point, because this is interesting. We didn't think about it, I must be honest. I have to check how much we can do. For instance, we can try to distinguish between homogeneous and heterogeneous sector in terms of, I mean, what's the universe of what could be produced, because we have information, for instance, at industry level. So we can think of an industry as we know that it produces a lot more differentiated products than others, and we can concentrate on those instead of the others. And also for this large procurement sector versus small procurement sector. So these two are excellent points that we didn't address, and that's going to be interesting. Also the point of understanding, I don't think we can say a lot in terms of what characteristics drive the decision or the opportunity to become government contract, because this information we didn't get them easily. The information on the firm because of privacy stuff, anonymization, and blah blah blah. So eventually they prevented us to get a lot of information that would allow us to formally identify firms. So that I mean, we know some generic information, we can map them to a given, let's say, taxpayer, but the amount of information is not as deep as it would be required to understand the causes, the drivers of accessing public, of the decision to become government supplier. Finally, if there are no other questions which I found, there is Sonali, who asks whether there are shocks to the government demand during this period. I had a graph which I checked, I couldn't find them in the slides or in the easily retrievable stuff of this project, which actually show an increase in government spending over time in our sample, but not a remarkable shock. So, okay, over time, the government spent more and more, especially close to the election. I don't remember which year it was. I think it was 2018, one election, or 2017. I don't remember. Well, I mean, it's coherent with this kind of electoral cycle behavior, but there were not, let's say, a drop afterwards. So the government spending kept rising over time. So this is not, let's say, we cannot identify such kind of a shock. But also these kind of things about consumables versus capital goods, that's interesting. Unfortunately, again, we have information industry, but not on the exact product, okay, at HS level. To go HS, we should use custom data, and we could. But the point is, at that point, we have whether there is an impact on imports or exports, but not really on, let's say, I mean, it's the link with firm growth and procurement becomes, let's say, less clear cut, because we could see whether firms start importing more, yes, but we don't know whether they, for instance, buy second-hand stuff from firms who don't require some machinery just to increase production. We couldn't say that, these kind of things. So I don't know if there are other comments, but I think I went on. But anyway, Anirudh, I want your slides.
Sure.
That's great. Thanks. Let's maybe I can just throw over to Hannah to get a question out as well in a couple of minutes.
Thank you. That I was so smooth there, right? Well, I think this is a really unique opportunity to ask a really, really important question. So like kudos to Filippo, of course, and the team for working through this data. Kudos to the Ugandan government who actually reached out, as I understand it, and asked this question, and to Anirudh for having turned all of this into trade. So it's a little disheartening, right? So first, two things that are important here, I think. First is that procurement is such an important part of trade and trade negotiations and agreements, and also the work at the WTO. So what does it actually mean for trade? That's the one thing. And the second thing is for development, right? So if you have a government and budget that you want to use, it's a little disheartening that it doesn't really work for development as we would have expected. So I would like to throw out the question and just a one sentence. So assume that you have policymakers, the elevator pitch, the sentence or two. What is it that we can tell policymakers after this very unique study and with this perfect storm of information that has gathered? Filippo and Anirudh, what do we tell policymakers?
Shall I go first? Well, I'd say that it is a tool. I mean, it's important. Industrial policy can work, but doesn't work for everything. We cannot think. I mean, as much as we cannot think of tariffs to solve budget issues and bring back manufacturing in a country, we cannot expect industrial policy and public spending to be the only tool that causes firm growth. Because if you don't address the reason why a firm doesn't grow, I mean, in Italy we would say people love small firms, small and medium firms, family-owned firms. If you don't solve the reason why people prefer these kind of firms, we cannot ask why they don't grow. Because of course, I mean, if you don't solve the reason why there is an incentive to stay small, then I mean, of course, it might not be effective in increasing. Then our result doesn't rule out that some firms really benefited and grew out of private demand, but on average, that's not the case. So that I would say that use it, it's good, helps, but it's not the only thing you have to do. If the objective function is to actually spur firm growth, because if the objective function is different, then the game changes.
Yeah. So for me, I think it was the finding about the crowding out is actually very telling. That's the classic sort of Keynesian crowding out effect. Because what this paper is then telling me is that government demand is crowding out private sector activity. So the government has to be very careful about the kind of goods and services that it wants to procure, right? So, the sort of standard macroeconomic framework, there is just as much loanable funds in the economy. And if a lot of that is going to the government, then there's less left for the private sector. So this paper seems to suggest the same sort of a mechanism playing out. Government demand is crowding out private sector activity because the firms are actually only catering to government demand, and that has a bearing on private sector activity. So again, I think the government needs to be more responsible about the the composition of the government procurement. I think that's an important takeaway from it.
Good point.
That's a great point to wrap it up on. I think we've covered a lot of really good territory. I mean, for me, what I take away from the session is, firstly, just how good a piece of research can be when we have nice data and some of these new methodologies. I think it's great that Filippo got into that a little bit. So differences in differences is something that's seen this kind of renaissance over the last 5 years or so. So using some of those new estimators can really teach us some very interesting things about what's going on. And then, the trade dimension of all of this was interesting when we have this large source of demand that can target it towards the home market. How effective is that? And then, of course, the question we didn't really get to, what's the effect on third countries? I think that was touched on by sort of saying that there's this dispersion between the quantity of procurement in terms of number of contracts that goes to domestic firms versus value. And we see that share between foreign and domestic firms. So I think there's tons of interesting material in there. Trade and government procurement is something that's been on the trade agenda for a while. It's controversial. There are countries that want to make something more formal of it. There's the government procurement agreement, of course, already WTO. Then there are other countries that don't want to go any further with it. And I think part of that is the split that came out in those last concluding comments, where we can see this as something that's effective from the point of view of developing local firms, or we can see it as something that needs to be managed carefully so as not to have this crowding out effect in private sector development. So I think reconciling that is something that more empirical work can do over time. So thanks, Filippo, for coming along and presenting the paper. We really enjoyed having you. Thanks, Anirudh, for the great comments and the discussion. We really appreciate that. We're going to take the month of August off. It's the summer here in the Northern Hemisphere. So we'll be back in September with our next webinar. So please stay tuned on LinkedIn and through our mailing list. And we'll come through to you with further details of the webinar in September. But thanks to everyone who's joined us in this first half of the year and today in particular. Thanks to our speakers. Thanks as always to Hannah for being such a great colleague and friend to work with.
Yep. Thanks a lot.
Right back at you.
Okay, take care.
And also to the audience, obviously, everybody in the tribes being so generous with questions and so on. And yes, recording and presentations will be on the website. And we hope to see a lot of you in Geneva. And thank you also to all of you who sent in your papers. And see you in September.
Yep, see you in September.
Indeed.
Bye-bye.
See you. Enjoy your summer.
Thanks. Bye.